For this week's Smith Business Close-Up, we are on location here at the University of Maryland. And joining us at the Robert H. Smith School of Business is Kristen Fanarakis, who is Assistant Director at the Center for Financial Policy. Thank you for being with us.
Thank you for having me.
We want to focus in on what's happening in China from an economic standpoint and how that affects global volatility. And the story of China's economy over the last decade or two has been an amazing thing.
It has. It's really been a marvel. They've averaged about 10% growth over the last 30 years, and the volatility that we've seen of late is that you're starting to see it slow, perhaps a little bit quicker than policymakers would have liked. Some are the last official read is around 7% for growth for this year, but some are predicting that it could be as low as 4%, which is significantly slower than policymakers would like.
It's an amazing thing. If we had 4% growth in the United States, it would be boom times.
Well, we would be back to our long-term average. Our long-term average in the U.S. is really around 3.5% to 4%. So that's where one of the issues that we've had recently is, since coming out of the financial crisis, is that our recovery has been much slower because we've averaged only around 2% growth.
But the idea that in China, if it were actually 4, it would be like a recession, but not the classical definition of a recession.
Exactly. So China's version of a recession is 4% growth, so exactly.
Is there the sense that they need to keep the wheels turning rapidly in China? They can't let it slip into anything remotely like a recession for political reasons as well as economic? Absolutely.
They need that growth, and they are trying to transition the economy to be more consumption-led, which is what we have here in the U.S. Or primarily a consumption-led economy. China in the past has been a manufacturing-led and an output-led growth.
I was going to say it's perhaps easier for a strong central government, which they certainly have, to mandate spending and large-scale activity by governments and corporations than it is to take that last step of getting the consumer to do something.
It is, and one of the things that they've also been trying to do in China is spur much more entrepreneurial growth, and that's where they're struggling. They're finding that it's a little harder to mandate that spending than it is to sort of mandate produce X amount of widgets. So
why is it important to us sitting in Maryland what happens on literally the other side of the world?
Global markets are, as we saw from the financial crisis, are far more interconnected today than they ever have been in the past. And so you really can't ignore, China's the second largest economy in the world. You can't ignore if they're having economic issues and they're having their or stock market issues. You really can't ignore what's going on there. And it's, as we saw in the fallout from the Lehman crisis, the world is far more interconnected than even some policymakers here at the Fed understand.
So what are policymakers in China trying to do now?
I think they're trying to figure out how to get their growth back up. How do they get their populace to start consuming more, to start buying more cars, buying more clothing. They're already some of the largest consumers in certain sectors, but broadly speaking, to get the masses purchasing.
Kristen Fanarakis joining us from the Smith School of Business. Thank you for being here.
Thank you.